Thanks for joining us today on Market Call. I'm Marella Fernandez. Gordon Reid with us on the show, President CEO at Goodreid Investment Counsel. He'll take your questions today on American Equities. Here's how to reach us, 1-855-326-6266. If you want to call in, you can email as well, marketcall@bnnbloomberg.ca. Gordon, good to see you. Thanks for coming in.
Hi, Marella.
We have CPI numbers out in Canada. They did creep up to 2.4 from August to September, year over year, of course. Let's talk about whether you think that's a problem for the Bank of Canada when they make a decision later in the month on a rate cut.
I think it's a bit of a problem in terms of messaging. I think they know what they want to do, and this is a bit of a headwind in terms of their messaging. I think they would like to cut rates. They've been quoted, some of the officials have been quoted as saying, you know, it depends on which measures you look at in terms of inflation. And of course, as you know, Marella, there's a few ways to look at it, excluding some
factor
things.
In this, factor
exactly.
out that, yes.
Exactly. And I think they're more worried, as they are in the United States, about the health of the economy, making sure that the economy doesn't roll over, than they are about inflation. I think they're ready to accept the fact that inflation might be just a touch stickier than it would be in a perfect world, which might take them over that 2% mark that is largely artificial, but they've set that, and they're willing to live with that.
Okay, let's talk a little bit about the markets and where we are today. The TSX dropping, the American market's a little bit mixed, I would say today. Gold seems to be losing. Metals are losing after a couple of days of gains. Yeah. So where are you on the bubble theory and whether we are close to something like that?
Yeah, you know, we don't see the constituents of a bubble, a classic bubble being built. Certainly the markets have moved forward. You can't deny that. And to most people, that's a good thing. But of course, it brings with it some risk. And then that bubble label starts to be applied by some. In 1996, I think it was, Alan Greenspan, who was the Fed chairman at the time, famously talked about irrational exuberance. And, you know, when I look at the market today, I kind of want to label it as rational exuberance. There is exuberance. And that's a bit of a scary thing in terms of markets. You like markets to be discerning. You like markets to always have their feet to the fire, really analyze. But markets are like a lot of things. If enthusiasm builds, the focus moves away from the company and towards the stock price, and people become momentum investors. We've seen a little bit of that, but we've also seen very, very strong corporate earnings. We're in a different environment where the leadership is fulfilling perhaps a third leg of so-called economic revolutions, from the industrial to the first act of the technology revolution, and now we're in the AI revolution. And I think we're in the early stages. And
not just promises of what's to come. Are you seeing some of the value come through from some of these AI high-tech companies?
Absolutely. You know, the returns that they're gaining off their investments, and the investments are mammoth. This year, the hyperscalers will invest close to $500 billion in data center development to create the capacity for what we all are told is going to just change our lives. And we're already seeing it in a lot of ways, I think, each of us. So they're making money. I looked the other day, and Google is trading at a discount to the valuation of the market as a whole, about a 3.5% discount, even though its growth rates is a number of times greater than the average company. So these companies, some of them have moved to levels where the valuations are stretched, but many of them, that's not so.
Okay, we're going to take a quick break. Gordon Reid with us today, Goodreid Investment Counsel. He's taking your questions on U.S. equities. Here's how to reach us. We're back in a moment. Welcome back. Let's go to our first question coming from Tony today. Should I sell AMD? Is a question for Gord. Advanced Micro Devices, of course, chip maker.
Yeah.
Is this a company that's beginning to close the gap with the other chip makers? What do you see?
Well, they've done a deal with OpenAI, as a number of firms have, and we get into these terms, circular economics. You know, where OpenAI is doing deals with companies for a promise of business into the future, and it's sort of this circular, if you scratch my back, I'll scratch your back. The deal itself propelled the stock quite a bit higher. I don't think it's a bad deal, but I'm not sure it was deserving of the valuation bump that AMD got. There's quite a dilutive effect. They're going to issue a lot of warrants, I think 160 million warrants upon success, which will dilute their success.
So there's certain milestones that have to be met first.
Correct.
Okay.
Correct. And I think when you do peer group analysis, Marella, I wouldn't choose AMD of the big players. The big three, I think, in that space are Broadcom, AMD, and NVIDIA. And I'd probably put AMD in third place, to be honest with you, out of that group. So I would, to answer the question, yes, I would be a seller at this point of AMD.
Okay. Let's go to our first caller then. Amin is on the line in Ottawa. Hi, Amin.
Good afternoon. My question is about gold.
Right.
Gold has gone down today.
Mm-hmm.
Shall I buy more? I have three companies, Alamos Gold, Barrick, and the one you told me to buy last time.
Okay, thank you for the question. Gold futures here down $211, dropping almost 5%. Gord, would it be a good time to pick up here, or what would you do?
Well, I don't think you can really answer the question on the basis of the commodity itself. I think it has to do with how you've constructed your portfolio, what percentage gold makes up of your portfolio. Do you have any gold? How do you invest in gold? At Goodreid, we look at gold as a bit of an enigma. It isn't really open to fundamental analysis. You can't really understand the
valuation,
the true value of gold, which of course makes us fairly nervous. But we understand that it's driving forward on forces that are macro in nature, global in nature. Central banks around the world are losing faith in fiat currencies, especially the U.S. currency. There's geopolitical issues going on, and we understand that is in favor of gold and perhaps pressure on the U.S. dollar. So do you have a piece of gold in your portfolio? At Goodreid, we own Agnico Eagle in our Canadian portfolio, managed by Donnie Moss, who's our Canadian manager.
Percentage, where do you?
We're at about 4.5%, which is probably 40% of the weighting of gold in the TSX. That's by design. We don't feel comfortable owning a full weighting in a commodity like gold. And I think you have to put it in historical context as well. I was talking to someone the other day, and we were sort of looking at it from a very long view. In 1980, gold hit $800, and believe it or not, I'm old enough to remember the lineups on the street of people who were so
buying or selling physical gold.
Exactly. Yes. The excitement around it was amazing. So it was $800, and call it today at 4,000 or 4,500. So it's gone up eightfold. Around that same time, the Dow Jones Industrial Average was probably just over 1,000. So the Dow, the market, if you want to look at it that way, has gone up 45 times versus 8 times. So if you put it in a long-term perspective, gold really hasn't kept up. Has it kept up in the last year, 2 years? Of course it has. And there's real reasons for it, which is why we're participating. But we really just want to participate to basically hedge against it continuing to do well or dropping. We want to take the edge off any differential that we have against the market.
Okay. The question itself as to whether or not he should hang on or buy more then depends on how much he has in his own portfolio.
Absolutely.
Okay.
Absolutely. And I'd advise that he talk to his advisor and talk the whole thing through.
Okay. Let's try to get to another caller here. Joseph is on the line in Montreal. Hi, Joseph.
Hey, thanks for taking my call. Gordon, I want to hear what you have to say about Lennar and more generally about the home builders in the U.S. They're finally doing well this year on an upward tick. As we're going into next year on a possibly lower rate cycle in the U.S., how are you positioning Lennar or any of the home builders in your portfolios? Thanks.
Okay, thank you for the question.
We do own a number of home builders in our U.S. small cap portfolio, and like them very much. We owned Lennar back, I'd say to the spring, but then they did a reorg, and they spun off that piece of their business that owned the land, which I think was a fairly smart move from a corporate standpoint, but from an investment standpoint, we didn't want to participate because the tax legislation in Canada isn't really very clear. Often these deals get a go-ahead from the IRS, and there's very clear tax tracking through the IRS, less clear when it comes to the CRA position on it. And we know that if you own these companies, they go through a reorg, the tax treatment can be very, very costly. So we moved away from Lennar, but we still own other home builders. We think the home builders are very well positioned. They're much better managed than they have been in past cycles. They're extremely interest rate sensitive. And what we have to see with interest rates is an unlocking of mortgages, so getting people to move. In the United States, you can refinance at low rates, which virtually every American homeowner did at very low rates. And what's it going to take for them to move? So say they have a 3% mortgage. What's it going to take for them to give up that 3% mortgage, which in the United States is not portable, and move?
Interesting to know. Okay, you can't take the mortgage with you. We're going to take a quick break. Gordon Reid with us today of Goodreid Investment Counsel. He's taking your questions on U.S. equities. Here again is how to reach us. We're back in a moment. Dark.
Yeah.
Welcome back. Thanks for joining us here on Market Call. Let's go to the phone lines. Rick is on the line with his question. He's in Vancouver. Hi, Rick.
Oh, hello. Hello, Gordon. My question is on Starbucks. When they hired Brian Niccol as the CEO, the stock price shot up 25% in one day. But it seems that his turnaround efforts have been met with some skepticism, and the returns since then have been more muted. So what would you recommend? Should I continue to hold it, or should I cut it loose?
Okay, so thank you for the question. This was the man behind Chipotle's rise, and he's trying to do a turnaround at Starbucks. And I've noticed they've downsized in their products. So what used to be a tall is now a tall. So he is trying to really do a big upheaval there. How's it going? What's your take on the leadership?
Well, he certainly has a pedigree, and you can't deny that. Whether he can apply that with success to the Starbucks model is another question. They've got some serious issues. One of them is that China is a very big component of their story and their growth story. So it's both today and into the future. The other thing that worries me, Morella, is the approach that they're taking. They're a big proponent of stock buybacks. But when you analyze the financials, what you find is that they're using debt to finance their buybacks. So 10 years ago, 15 years ago, they had $500 million, $800 million of debt. Today, I believe the debt is around $15 billion. And they've basically used all of that to finance buybacks, which from a capital allocation standpoint, to me seems somewhat flawed. And for that reason, I've always stayed clear of this company.
Okay. Do you feel like there's a runway for him when you have a CEO who's put in charge of sort of a turnaround? Mm-hmm. Do you usually give them a sort of a 2-year time period to see what they can do? Yeah.
You usually give them a period of time. You don't want to be quarter to quarter. It takes time to turn around the big ship, as they say. But we've seen other turnaround attempts. One I could think of would be Target, which has not really gone very well. And right now, Nike is in the middle of the same. In the middle of the same. And companies, whether it's the last attempt to get the thing turned around or not, I don't know, but it's certainly late in the game because there's big problems and they feel they need sort of a Hail Mary. They've got to bring in a big hitter, and that in itself worries me. I'd rather watch it and basically pay a higher price for greater certainty in situations like that.
Okay. Let's go back to the phone lines. We have Tony on the line in Toronto. Hi, Tony.
Hi. Speaking about turnarounds, what is your thoughts on United Health? They report earnings next week.
Yeah.
It seems to have come off its lows. Do you think there's an opportunity for a turnaround here?
Okay, thank you for the question. Very down low.
Yeah.
In the summer, August kind of hit the really low point. It has climbed back a bit, but nowhere near, of course, where it was even at the start of the year. This company's facing a number of challenges. So where do you stand on United Health?
I think when you look at United Health, you have to take a step back and look at the whole sector and the healthcare insurance group. And I don't want to give too much away because one of my top picks is a competitor of United Health, and I'll talk about that later on. But in terms of United Health, they're faced with higher and higher costs against a revenue stream. So when you have a healthcare insurance concern, you take in certain premiums, and then of course you have to pay out claims. And that whole model was completely upended with COVID. It was upended not only because of how many claims came in, but the timing and lumpiness of those claims. So you can imagine during COVID, a lot of people decided not to get elective surgeries or take care of their health outside of COVID as much. So the margins of these companies did extremely well. They were very profitable because the costs against them weren't that big. Well, what happens is you get the echo.
The catch-up.
A catch-up, exactly. And that's exactly what's happened in the industry. I think that the whole industry is showing signs of bottoming. I think there's big opportunity in the industry. With a patient investor as part of a portfolio, this industry should be represented. I'm not sure that I would go with United Health. I'm going to talk about what my top pick would be later on in the show.
Okay, the high, by the way, was $625 at the end of this year, so it's down several $100s still. Let's go to Neil. He's on the line from Thornhill, Ontario. Hi, Neil.
Good afternoon. Thank you for taking my call. Gordon, it's fun. I'm going from healthcare to a product that people hate, Philip Morris.
Yeah.
I picked up a position earlier in the year. It's gone up. The revenues came out today and earnings came out. Stock seems down. They've just raised their dividend 9%. Yeah. And they're growing around the world. And, of course, I think if they legalize marijuana, they're just going to move right in. Mm-hmm. What do you think about Philip Morris for a several-year hold? Thank you, and I'll hang up.
Has Philip Morris sort of expanded what it's doing?
They've got tentacles in those areas, but in terms of materiality, it's not showing on the radar yet. It could into the future, but for now, not so. To Neil's point, you have to know what you're buying and why you're buying it. And I mean, we all know that Philip Morris is a tobacco company, that the headwinds are that society, governments are pushing against them. More and more, you go to places where you just can't smoke.
Yeah.
And fortunately, I don't. But it's noticeable that people who do smoke are really working to find a place where they can smoke, and it's sort of like a negative, like a super negative. Mm-hmm. So all of that is working against these companies and their sales and revenues. So when I say know why you're owning something, you're owning Philip Morris for the yield, for the dividend, not for the growth, not for expansion, not for revenue. You're buying it because they're a cash cow. They produce a certain amount of free cash flow, and they're turning around and paying it out through a dividend to their shareholders, and that's why you own it. And as long as that is intact, it's a strategy. The danger, of course, is that the revenues will shrink to a point where they won't have the free cash flow. to allocate, and your dividend will be in some jeopardy. So on something like that, I would pay particular attention to the payout ratio. So peg where it is, and I don't know, to be honest, where it is right now, but say it's at 60%, and watch that very, very carefully quarter to quarter. What's their payout ratio? So Neil mentioned that they raised their dividend by 9%. What does that take their payout ratio to? Are they covering it with greater free cash flow?
Yeah.
Or are they dipping in to a greater piece, which increases the risk that dividend may not be paid out in the future?
Okay, we are going to take another quick break. We'll have a look at Gordon's past picks in just a moment. Stay tuned. Welcome back. Time now to look at past picks from Gordon Reid from October 22nd of 2024, so a year ago. At the time, Gordon chose Alphabet, parent company of Google, of course, on the NASDAQ. It was 165 US, 14 cents, and now it's up to 253.18 US, so a 53% return here, a total return of 54%. This is one of the few companies riding a huge initial AI wave. I imagine you're still invested in this.
We are. And I mentioned earlier in the show that Alphabet is still trading at a discount to the S&P 500 multiple, even after this wonderful run, and that's on the back of increased earnings. So, a valuation is a comparison, and it's in this case price to earnings. We're talking about is how many dollars of earnings am I making, or how much am I paying for each dollar of earnings? So there's a numerator and a denominator, and if they move up in concert, your valuation does not expand, and the worth of a company remains the same. And a lot of these companies are in that camp. They are growing earnings at such a rate that they can grow rapidly in price and still remain very good buys. So Google in particular, it depends on what day you listen to the commentators. Google can be, losing the AI race or leading the AI race. It doesn't matter. It's all noise. They are in the AI race.
Okay.
That's what matters. And they had a very big head start with deep minds going back to 2010, I think it was. In the AI race.
Okay.
So they're going to do very, very well. And then on top of that, you can stack YouTube, which has over 2 billion users. You can look at Waymo, and a lot of different initiatives that are feeding this wonderful
irons in the
company.
fire.
Irons in the fire.
Okay, let's get to Meta Platforms, which was your next past pick from October last year. 582.01 at the time, US, of course, 734.73 today. 26% upside, 27% total return. I always look at the number and think, okay, now would you still put money into this platform? Would you?
Yes. Yeah. And don't be scared by big numbers, because again, going back to what I was just talking about, if the earnings are big numbers and the price is a big number, it's just a number. And what you want to do is make sure that you're not paying 200 times earnings. So let's go back to the turn of the century when we had the internet bubble building. What happened then was that there was huge excitement, and many of these companies were thought to be the leaders of the future, but the prices were bid up before the earnings appeared. So companies like Cisco Systems, which many viewers would know, was trading at 80, 90, and 100 times earnings. So the air under that in terms of corrections or them not fulfilling promise was huge.
Yeah.
That's not the case today.
Okay.
So Meta trades somewhere in the mid-20s. In terms of active users, I talked about Google having, YouTube. Well, 1 out of 2 human beings in the world uses a Google product or is on a Meta product every single day. So they have incredible reach, which is incredible advertising dollars.
Okay, let's get to your third past pick, which is not a tech pick. Visa on the New York Stock Exchange, it was 284.79. At the time you recommended it, 345.77 right now, 21% upside. Total return 22%. It has gone a little sideways, I think, more lately.
Yeah.
Have you trimmed it all? What are you doing with Visa?
No, we haven't trimmed. We continue to own it. And, when you have a portfolio, every company doesn't move at the same time. So there's a leadership group and a subset. And companies can be, or stocks can be, in the shade and taking a rest for a period of time. And you shouldn't be too critical about that because they don't move in a straight line. You have to look at the fundamentals. Well, there's 40-some trillion dollars of consumer activity going on every year. And the plastic providers, Visa being one of them, are after their share. And Visa's been very, very successful at gaining their share. Inflation is an aid to Visa. The cost of products goes up. They make a piece that is a beneficiary of inflation. They issue about 7% more cards each year than they had out there in previous years. So long term, the sell side, that's all the analysts out there, are looking for about a 13% growth rate with Visa. Trades just sub 30 times earnings. It's a little bit cheaper than it's been historically. Trades well against its competitor, biggest being MasterCard. Visa being much, much larger than MasterCard, though. And we like the fact that the debit card business at Visa is very, very strong, and that's where people are gravitating in terms of their spend.
Okay.
So it's a good hold and a very stable hold.
Got it. All right, we're going to take another quick break. Stay tuned for Market Call. Gordon will take more of your questions when we come back. Welcome back. Let's go to Deborah. She's on the line from Okanagan Falls with a question today for Gordon. Hi, Deborah.
Oh, hi. Good morning. My question today is on GM. Gord, I bought on your recommendation some time back, and I've been holding a very steady course. There was a big pop today at 15%, and my question is, where do you see it going from here? And my secondary question is, other than waiting in a portfolio, when you see such a large increase in share price in one day, does this influence your decision to take partial profits immediately in a stock, or do you hold the steady course?
So many questions to answer.
Yeah.
Okay, let's talk about, first of all, they got a pop from earnings,
Yes.
and their adjusted earnings coming in higher than many had anticipated. So that's why you see that jump today of 15.5%.
Yeah.
Do you, when you get a pop, do you tend to trim this kind of pop?
We tend not to trim because it's on good news, and the good news is supportive of what's happened. There's the odd occasion where something rises so high, so fast, that you say, the enthusiasm is just overdone. It's happened in my career, but I wouldn't say it's a normal case. So this isn't that kind of a case. This is GM being incredibly inexpensive. It's had massive amounts of negative news, whether it's tariffs or the EV adoption being slow. It's trading at 6 times enterprise value to EBIT, very, very inexpensive. And they come out and they say, we're overcoming the headwind of tariffs. It's not going to be as hurtful. We're increasing our guidance for next year. So it's a classic case of a very low bar and a good result. And the stock is moving back to where we thought it should be in the first place. So to answer Deborah's question, what do we do now? Well, we hope that it creates a base here, that this is digested, and that future earnings calls and
move
reports
it up even more.
Are supportive of this and move it up even more.
Okay. Deborah, I hope that helps you make your decision. Let's go to Jack, who's calling from Montebello, Quebec. Hi, Jack.
Hi. Thank you for taking my call. I wanted to ask about Taiwan Semiconductor. I sold puts at $300 strike price, and it's having trouble getting above that $300. So I wonder if you think it's got some room to run, or is it maxed out at the 300? Thank you.
Go ahead.
Well, I'm not sure exactly where it's going to go in the short term. I'm not really the one to talk to from a trading standpoint. I don't consider myself a trader, and I don't, to be honest with you, think I'm very good at it. I'm a good long-term investor. And when I look at Taiwan Semiconductor, I see a company that is probably number one in its industry. Its industry is top of mind from a foundry standpoint, which is a production standpoint of fabrication of semiconductor chips. They control 2/3 of chip production. And to put that in context, Intel is barely on the list.
Yes.
So even though Intel is sort of the number one North American name, it doesn't even compete with Taiwan. So we like Taiwan long term. We're not a holder of Taiwan at this point, but it's certainly a good, solid company in a leadership position in a leadership sector.
Okay. Let's move on then to our next caller, Craig from Kelowna, BC. Hi, Craig.
Good morning. My question to Gordon is about Jacobs. I bought it on his recommendation quite some time ago. We're both familiar with the spinoff that it's had.
Yes.
My question isn't so much about that, but I was upside down on the stock for quite some time. It's finally come back. I think it's like almost a 52-week high right now. And I bought this stock thinking it was sort of the American version or equivalent sort of a WSP or an Atkins Real. It's kind of an infrastructure play.
Mm-hmm.
And I guess my specific question now that I'm back right side up is, do you think I should just get rid of this, or do you think there's room for this longer term? So that's really my specific question, is what to do with this thing now.
Thank you for the question, Craig. Jacob Solution, we don't have a chart for, but they are in that realm of engineering, construction services, and advice.
Yes.
What do you say?
We did own Jacobs, as caller referred to. We sold it on the basis of the spinoff because of the tax issue that I talked about earlier in the show, and that we didn't want to get entangled with a negative tax treatment of the spinoff. I think Jacobs is still a very good company. Another company I could point to that we do own in the same type of space is EMCOR, EME. And we've owned that for a very long time, had very great success.
Okay, so maybe he should look at that as a comparison.
Yeah, you could do a comparison, and peer group analysis is always helpful, because sometimes you find yourself looking at a very good industry or sector, but you might find that you're looking at number 3 or 4 in the sector. So you want to find number 1. And doing peer group analysis is another stage of analysis that may lead you to a better opportunity.
Okay. EMCOR, by the way, is up on our screen right now, up a little on the day at 692.55. Okay, we are going to take a quick break. Gordon's here to answer more of your questions when we come back. Welcome back. Gordon Reid with us today to answer your questions on American equities. Imran is on the line with a question from Ottawa. Hi, Imran.
Hi, Mariella. Hi, Gordon. Great show, guys. And thanks for taking my call. Gordon, I picked up some Honeywell just a few days ago around 208 US, and I'm hoping to benefit from it. Honeywell, I think they are splitting into 2 companies or different divisions. They have been in aerospace and other products. Besides aerospace, I think they're also in space arena, subcontracting work from MDA. So I'd like to get your perspective on it. Should I hang on to the stock, or should I just get rid of it and move on to something else? Okay. I like your perspective. Thanks.
Thank you for the question.
I'll hang up and listen.
So at 208, he's already gained about $2 on Honeywell. What do you think of Honeywell?
Very, very good company. It's always a matter of valuation with Honeywell. Based on our expectations of future earnings growth, I think it's reasonably priced. It's not incredibly cheap, but it's a good price. it is splitting into three pieces. They announced that early in the year. Actually, they're going to have an area of aerospace, another company dealing with automation, and the third, advanced materials. And then you'll be left with the original Honeywell, which is sort of the traditional Honeywell products that we know of: home sensors, climate control, and so on. So that's going to, come to us late this year, early next year, I believe. And there may be some good opportunities there. If you look at GE as an example, or a template for that, where they split into Verona and GE Healthcare, and then GE, the mother company, it did extremely well.
Okay.
And I think there's always some opportunities for that. But until they do it and I start to see some of the pro formas, I won't really be able to comment on the competent.
That being said, you'd hold on to it right now to see what happens?
Well, you could. And not to repeat myself, but again, you run into that tax treatment issue. And you have to be careful with this, because, and getting into it a little further, what happens is that when you are issued new shares, in the United States, they structure it so it comes through on a tax-free basis. In Canada, often these things are treated as a dividend. So you get full tax on it, and it can be quite hurtful on an after-tax basis. So you just have to be careful.
Okay, so he's got to do a little research on what that means for him, depending on how much money he has in that stock.
Absolutely, and sometimes it's very difficult to get answers.
Yeah.
Because it's simply CRA hasn't given an opinion.
Okay.
So what is the tax treatment going to be? Well,
stay tuned and find out.
Who knows?
Okay, let's go to Doreen. Doreen's on the line in Kelowna, BC. Hi, Doreen.
Hi, how are you this morning?
We're good. What's your question?
Good. I'm holding Mondelez, and I'm down a little bit, but I'm getting a dividend to wait. So I'm just wondering if you think I should wait, or if you think I should get out of the stock. Thank you very much.
Thanks for the question.
Doreen, it's not my favorite. I've always had a little issue with the, I'm getting paid to wait, because you're getting paid the dividend, but you might see your capital fall to the point where it wipes out your dividend and then some. So you have to look at the capital side of the business and make sure that it's a solid business, and not be there, as I was talking about before, with Philip Morris just for the dividend. So a company like Mondelez has got to grow, and unfortunately there's some headwinds there. First of all, their input costs are very high. So things like cocoa,
yes.
In the news, commodity prices higher. So their input costs are much, much higher. And then we get into societal changes. So people are eating less sugar,
less processed food,
GLP-1 technology or medication is leading people away from sugary snacks. And then finally, they're primarily an international company. So you've got foreign exchange issues to deal with. And that's really a toss ball. So you don't know, translating back into US dollars, how that is really going to play out. So for those reasons, I'd probably shy away from Mondelez. There's just too many reasons not to own it
at this point,
to work hard to own it.
Okay, let's try and squeeze in one last caller. We have about a minute left for Scott from Saskatoon. Hi, Scott.
Good morning, Marilla. I'd like to ask Gordon about BlackRock and any comments he has about the U.S. alts and private equity guys.
Okay, Thank you for the question. BlackRock.
Well, BlackRock, a wonderful proxy for the market. Trillions of dollars of assets under management and well managed. Larry Fink does a really nice job there. But we've seen with some of the regional banks, the private equity, private lending side is getting into a little bit of, or certainly just getting into the news, and there's been some defaults, and people are worried as the economic cycle matures, is this going to be, a classic credit problem? And BlackRock does have some exposure there. My guess is that it's fairly well covered. I do a little bit of work on that, if I were you, to make sure that you're not sort of running into a bee's nest. But But overall, very good company, and I think a really good proxy for the market. You can make sort of a market return. By market return, I mean as the market progresses, you can do as well. And then I think you can gather some alpha because they are good managers.
Okay.
And so for that reason, I like it.
All right. We are going to leave the questions at this point. We have new top picks from Gordon Reid when we come back. Stay tuned. Join us tomorrow on Market Call. Bruce Campbell will be on the show. He's president and portfolio manager at Stone Castle Investment Management. He'll take your questions on Canadian stocks. That's tomorrow. Let's get to new top picks from Gordon Reid. First on the list is Elevance Health, ELV, on the New York Stock Exchange. We talked a little bit about United Health and the situation it is in, pushed down for most of the year. Elevance Health is in the same space, but it's about a third of the size, I think.
Yeah, it's smaller, certainly. I think it's number 2 in the space, but it is smaller than United
So
Health.
health insurance, why do you like it?
Well, health insurance is a very integral part of the health solution in the United States. And much of the participation within the insurance company comes through an employer-based system. So you get a job and your health benefits come through a company like Elevance. Elevance we like because it's inexpensive. It trades at about half of the multiple of United Health. Its growth rates are comparable, and its structure is somewhat different. The model at Elevance is that about 2/3 of their commercial business, and they have about 45 million
People they insure.
Participants in their insurance plans. And about 2/3 of their commercial business is what's called a fee-based rather than a risk-based model. In other words, the employer takes on some of the risk of that. So an employer says, well, what's the rate to insure my group here? And the company says, well, it's X. And they go, well, that's high. Well, how can we get that down? And you say, well, my group is tends to be a younger demographic, healthier, and so on. And a group like Elevance would say, well, if you're willing to take on some of the risk of that, then we will lower your premiums. And that's a safer way for an insurance company to manage. So that's the model that Elevance is primarily using. They came out with earnings today. They were mixed, but primarily good because they created a floor, and the margins on their business were a little bit high and certainly historically high, but that was expected. So I think the market has to digest that and move off it. And as I said with United Health, I think this whole group is poised for a rebound and needs to find a floor before moving quite a bit higher.
Okay. Let's get to your next pick then is Rocket Companies, which is a real estate tech company, essentially, tech-driven. Tell me a little bit more about them and why you like them.
Well, they started as Rocket being a mortgage originator, and they've vertically integrated. We came to own Rocket through a company called Mr. Cooper. And Mr. Cooper was a mortgage service company that we owned, and it was taken over by Rocket. Our clients did very, very well, basically doubled their money on that investment, and we just assumed the new shares of Rocket because we like the model. So Rocket, a mortgage originator, buys Mr. Cooper, a mortgage servicing company, and they also bought Redfin. And Redfin, some people might know, is an online real estate company. So they have online listings and a brokerage. So this whole vertical integration is going to play very well, we think, into lower interest rates, more activity in the real estate market, and we think it's well priced and well positioned.
Okay, let's get to your third pick then. Synovus Financial, SNV, on the New York Stock Exchange, commercial and retail banking. Why did you pick this in this space?
Yeah, a very high quality bank. Year after year gets very high marks for being a trusted bank, a good regional. They as well have some reorg news. They were acquired by a company called Pinnacle, and Pinnacle is a Tennessee-based bank. Synovus was a Georgia-based bank. Pinnacle, also a very, very good bank, trades at a very good multiple. Lots is happening in the banking industry. Loan growth is good. The yield curve is steepening with short-term interest rates falling, and that's very good for banks. And we're seeing a fair bit of capital markets business also happening. So the combined entity is showing very good promise for even short-term growth metrics, and it's just not priced for it. So we're very happy with it.
A $6 billion market cap for this company. Okay, we do have to leave there. We're out of time. Gordon Reid, good to see you. Thanks for your time.
Thanks, Morella.
And join us tomorrow for Market Call. We'll see you again then. Have a good day.